Hello, everyone interested in self-development and economics. Today we will talk about a topic that concerns almost everyone, about changes in exchange rates and exchange rate differences. This explanation is for entrepreneurs, managers, and anyone interested in the economic impact of currency fluctuations. We'll use simple examples and clear explanations to show how to account for currency and currency settlements in business management. We will understand what exchange rate differences are, why and when they arise, and we will also be a little surprised that there are many situations when exchange rate differences do not arise, despite changes in exchange rates. Let's begin. We'll focus exclusively on the rules within International Financial Reporting Standards, IFRS, excluding national accounting variations. Because my audience includes viewers in countries like Kazakhstan and Germany, we'll focus on IFRS, excluding national accounting rules. To understand this topic, we need to define some key terms related to economic processes. The price of one currency expressed in another is an exchange rate. For example, if we record transactions in zlotys and want to buy euros, and the bank offers 1,000 euros for 4,140 zlotys, the zloty to euro exchange rate is 4,140 zlotys per euro. An exchange rate difference is the change in the value of assets or liabilities resulting from currency fluctuations. While we were considering the purchase, the euro exchange rate changed, and the bank is now offering us 1,000 euros for 4,144 zlotys. This means that between the cost of 1,000 euros then and now, there is an exchange rate difference of 4 zlotys. Functional currency is the primary currency used in a company's business operations. All transactions are recorded in the functional currency. Let's consider a Polish entrepreneur as an example. He conducts his business in Poland and conducts almost all transactions in zlotys. For him, the zloty is the functional currency. Reporting currency is the currency used for a company's financial statements. It may be the same as the functional currency or different from it. Let's imagine that our entrepreneur has an investor from Germany, and since the main investor of his startup invested euros in his business, then every quarter our entrepreneur provides him with a report where all the results of the activity are presented in euros. Transaction currency is the currency used for a particular transaction. Let's imagine that for work we needed furniture fittings from China, and according to the contract we need to pay in US dollars. The currency of this transaction will be the US dollar, which in accounting will be additionally expressed in the equivalent of the functional currency zloty. Let's illustrate these terms with another example. Our entrepreneur carried out an export operation, sending a furniture set consisting of 12 items overseas. He received payment, of course, in dollars. In this case, the transaction currency is the US dollar, the functional currency is the Polish zloty. The transaction will be recorded in this currency among all others, and at the end of the quarter the investor will be presented with the reporting currency, i.e., the euro. If everything is clear with these terms, let's move on. Let's return to our main topic. What are exchange rate differences? An exchange rate difference arises when a company conducts transactions in a currency other than its functional currency, and the exchange rate of that currency changes over time. Example: a company operating in the Eurozone entered into a contract to sell its goods for $1,000. The exchange rate on the date of the transaction was 0.92 euros per dollar, with a payment delay of 1 month. A month later, when the buyer paid, the rate was already 0.89 euros per dollar. Instead of 920 euros, the company received 890, although nothing happened for the buyer. This amount, 890 minus 920, equals minus 30 euros, and this is the exchange rate difference. I hope this is clear so far. Now we can move directly to the rules for calculating exchange rate differences, or their absence. Let's start with the situation when we simply have currency in the form of cash. Point 1. Initial currency valuation. When an enterprise receives money in foreign currency, it is reflected in the accounting at the rate on the date of receipt. If a German enterprise received $10,000 and 9,100 euros were spent to purchase them, the purchase rate of 0.91 will be recorded in the accounting records. According to IAS 21, this is an international standard that regulates the reflection and accounting of exchange rate differences. Transactions in foreign currency must be converted into the functional currency at the exchange rate on the date of the transaction. The price at which we actually bought the currency is the cost that should be reflected in the balance sheet. So, let's imagine that the entrepreneur we mentioned earlier bought 1,000 euros for 4,150 zlotys. Thus, we have 1,000 euros with a book value of 4,150 zlotys in our balance sheet. And this book value of the currency will remain unchanged until the time comes to draw up financial statements. The new reporting or the currency will not be used in the transaction, in which it will be necessary to revise its value. Let's draw up a schematic balance sheet to reflect the situation clearly. Let the initial capital be 10,000 zlotys, which were deposited into the current account. Then, after the purchase of currency, the current account will have 10,000 zlotys, but in two lines, 4,150 zlotys in the form of euros and 5850 in the original zlotys. That is, the recognition of the value of the currency is carried out at actual costs, and no exchange rate differences arise. Let's move on to point 2, revaluation of the currency on the reporting date. On each reporting date, usually this is the end of the month or quarter, it is necessary to revalue the value of the currency at the exchange rate current on the reporting date. Therefore, let's return to our example. Let's assume that we did nothing with the purchased 1,000 euros, that on the reporting date the exchange rate was 4.1308 zlotys per 1 euro. Thus, we find that our currency has lost value compared to the cost of its acquisition. That is, in the balance sheet we should have 1,000 euros at a cost of 4,130.8 zlotys. The old cost is 4,150 zlotys. Therefore, we need to recognize losses in the amount of 4,130.8 minus 4,150 equals minus 19.2 zlotys. In our training balance sheet, the assets will no longer be 10,000, but 9,980.8 zlotys, and the balance will be equalized with the recognition of losses from this exchange rate difference. We already know what happens with exchange rate differences when buying currency, and what will happen if nothing is done with the currency. When an enterprise uses a currency or converts it into a functional one, a difference may arise between the accounting rate and the actual selling rate. First, a memory note. As long as nothing happens to the currency that is in the bank or in the cash register, except for the case of preparing financial statements, no exchange rate differences arise either. But as soon as we use it in a transaction, it must be revalued. Let me explain with two simple examples. Example 1. Exchange 400 euros back into zlotys. As you remember, we have 1,000 euros in our current account. When preparing financial statements, we were forced to recognize a loss, since the exchange rate became 4.1308, and now we decided to exchange 400 euros back into zlotys. But the exchange rate at the time of exchange is already 4.1503. Let's calculate the exchange rate difference. Let's estimate the original value of 400 euros in accounting. 400 multiplied by 4.1308 equals 1,652.32 zlotys. This is a digression to explain the calculation. However, avoid this calculation method. When this is your only currency transaction, such calculations will be correct. But what if during this time you manage to buy currency, for example, 5 times and each time at a different rate? The solution here is very simple. In accounting, you need to reflect not the exchange rate itself, but the amount spent on its purchase. Then it will not matter at all to you at what rates the currency was purchased in each case, since you will automatically, by dividing the estimated value of the currency by the face value, always get an average weighted rate. And this will be the correct estimate. Therefore, the correct calculation should look like this. 4,130.8 divided by 1,000 and multiplied by 400 equals 1,652.32. The amount received from the exchange at the new rate. 400 euros multiplied by the rate of 4.1503 equals 1,660.12. Everything is clear here. The difference between the amount received from the exchange and the accounting value is 7.8 zlotys. We have made a profit, and it should be recognized as exchange rate income in the profit and loss statement. Now let's consider a situation where at the same time we decided to purchase goods from a foreign supplier for 500 euros. The original cost of 500 euros in accounting is 2065.4 zlotys. When calculating the current valuation of the currency, we use exactly the same exchange rate of 4.1503. 500 multiplied by 4.1503 equals 2075.15 zlotys. The difference between the book value and the actual amount spent. 2075.15 minus 2065.4 equals 9.75 zlotys. Because the goods are non-monetary assets, this difference is recorded as a financial expense, which we'll discuss later. Now, if everything is more or less clear with cash currency, let's move on to a topic that will surprise unprepared listeners. Namely, to cases when, regardless of changes in exchange rates, the exchange rate difference is not accrued. In order to begin to understand mutual settlements and their magic, we need, first of all, to study two new terms, monetary and non-monetary items. All currency items in financial accounting are divided into two categories. Monetary items are, for example, cash, debt in currency, currency loans. Up to this point in our video, we have only dealt with monetary items, and everything was easy and simple for us. Non-monetary items are fixed assets, inventories, investments, delivery obligations. They are recalculated only once and only upon initial recognition. Exchange rate differences on them are not taken into account in the future. Let's take a closer look at what is what. According to IAS 21, monetary and non-monetary items are defined. Are as follows. Monetary items are assets and liabilities that are expressed in a fixed or determinable amount of money. Such items are translated at each reporting date at the closing exchange rate. Examples of monetary items. Cash and cash equivalents. Accounts receivable, if they are payable in a fixed amount of currency. Accounts payable, again, if they are payable in cash. Bonds and other debt instruments. To help you decide which item is which, ask yourself, when I close this item, will I get cash? If the answer is yes, then the item is monetary. If, however, something other than cash is expected to be received instead of cash, the item is non-monetary. For example, if you made an advance payment for goods in foreign currency, then in the end you will not receive money, but the goods will arrive to you, although the debt until the moment of its receipt is expressed in monetary units. This article is non-monetary. Non-monetary items are assets and liabilities that do not imply closing by payment of a fixed amount of money by one of the parties. They are not subject to translation at the exchange rate at the end of the period. Examples: fixed assets, buildings, equipment, supplies, intangible assets. Accounts receivable, if it is closed by delivery of goods or services. Investments in subsidiaries and associated enterprises. Now about the same, but in simple words. Imagine that you made an advance payment under a foreign currency contract for raw materials for your furniture production. At this point, as we previously considered, an exchange rate difference arose, which we recorded. Now we received our high-quality wood at the warehouse. The batch arrived in two cars. One arrived at the warehouse at 23.58, the second at 0.02. Accordingly, the date and accordingly the exchange rate changed. Did the value of the wood change? Of course not. If the seller owes us the goods, then he will deliver the goods to us. That is, the price and valuation in the functional currency have long been fixed at the time when we paid for it, and the delay in delivery does not affect the value of the received asset. The valuation of non-monetary assets is carried out according to the rules that are already regulated by other standards that will need to be applied. But this will no longer have any relation to exchange rate differences. Monetary items are translated at the rate on the reporting date, and non-monetary items either remain at the historical rate or are later valued at fair value in accordance with other standards. Example: let's say our company decided to purchase new equipment for production. A supplier from Germany issued us an invoice in euros, and we paid an advance payment of 5,000 euros at the rate of 4.2 zlotys per euro. This means that an advance payment of 21,000 zlotys appeared in the accounting records. Now an important point. Since we purchased a non-monetary asset, and the equipment will arrive, the advance payment amount is recorded in zlotys at the rate on the dates of the advance payment. And in the future, even if the rate changes, no exchange rate differences arise for this payment. Let's consider the same case, but with one important difference. Payment occurs after receiving the equipment. On the date of receipt of the equipment, the rate was 4.2 zlotys per euro. And in the accounting records, it is reflected in fixed assets in the amount of 21,000 zlotys. However, the payment to the supplier was not made immediately, but a month later. During this time, the euro rate changed to 4.3 zlotys per euro. This means that the actual payment has already amounted to 21,500 zlotys. And the debt to the supplier is a monetary item, since it is expressed in foreign currency, and therefore is subject to recalculation. Therefore, we must reflect the exchange rate difference. At the time of recognition of the liability, Accounts payable in the amount of €5,000 were reflected in the accounting at the rate of 4.2, i.e., 21,000 zlotys. At the time of repayment of the liability, the payment date, the rate rose to 4.3, and the company was forced to pay 21,500 zlotys. That is, the difference of 500 zlotys is an exchange rate loss, which is written off to the company's expenses. Conclusions. Unlike the first example, where the prepayment fixed the value of the asset without subsequent exchange rate differences, here we have a monetary debt, which is adjusted at the current rate. Therefore, this second scenario results in an exchange rate loss, directly impacting the company's financial performance. Let's go over other cases of exchange rate differences. Receiving a foreign currency loan. It is possible to recalculate the debt when the exchange rate changes. Salary in foreign currency. Rent in foreign currency. Interest on foreign currency loans. A long-term investments in foreign companies. A dividends received in foreign currency. I haven't covered every possible scenario. However, at this point you already understand the reasons for the occurrence of exchange rate differences, the main terms of the definition, the rules for reflecting exchange rate differences, as well as there are cases when they do not occur. Please subscribe, leave comments, and like this video. I hope to tell you many more useful and interesting things.